Good morning and welcome to Prime's COVID-19 financial update. I'm Olivia Long, Managing Director of SMSF, and today we are joined by Jonathan Bayes, our Chief Investment Officer, and Mark Johnson, who's our partner from our Wealth Division. Before we commence, just a few housekeeping items. We will be taking questions and answers at the end of the presentation, so if you do have any questions throughout the presentation today, click on the Q&A button that's in the middle bottom of your Zoom screen, and that will come through to us and we'll attend to them at the end of the session. So at this point, I'm going to hand over to Jono.
Great. Okay, so let me see, share the screen. Alrighty. How's that, Liv? All good? Well, thank you for giving up 20 minutes or half an hour of your morning, guys. I hope everybody is surviving their time at home and not ready to throttle loved ones. We did another version of this about a week ago, just internally, and very interestingly, as I was thinking about it this morning, even in spite of sort of a 6 or 7% move within the course of the week, the conditions this morning are exactly the same as they were last week. We're at exactly the same level on the market, and you know, we'll probably start the morning with the same level of optimism that we did at this time last week. But the reality is that we really haven't gone anywhere. There's been a huge amount of volatility. I'm sure if you're following the market, you know, it's bringing out all the usual emotions because it is so uncertain. But the reality is, which we'll go through in the next 15 minutes or so, is that I just don't think it's likely to ease anytime soon. But the positive is that after the falls we've had, there's some value opening up. So I'll just jump straight on here. The first page of the presentation just outlines our simple thoughts. Yes, it feels like the last week has been a month, but the reality is not a huge amount has changed in the last week. We think that everything is entirely dependent upon the control of the virus in the United States, and how quickly that economy gets back, that society gets back up and running, will be the key determinant as to when we actually get a durable rally in the share market. I would say that the rally that we've had over the past 2.5 weeks is no more than a bear market rally at this point in time, and just an unwind of some very heavy selling that we got through the mid part of March. But there's nothing at this point in time to make me feel confident that the rally's got much of an extension to it. The other things that we're trying to sort of pass as we go through, you know, portfolios and the like, is just what sort of economy we're going to emerge into on the other side of this, and indeed when we're going to emerge, and in what form, back into sort of a normal existence. You know, is it an immediate moving back into normality, or is it partial? And again, the timing of it will probably differ country by country as well. The other important thing to note is that we didn't get a recession back in the GFC in 2008, so this crisis will be a far greater significance, I think, for the economy as a whole. We had some share market losses back in 2008, and some funds were locked up, but the reality is we didn't see a deep recession in Australia. We were very fortunate that we had the reignition, if you will, of the Chinese infrastructure boom, and that helped the miners, and we had a collapsing currency, and we in a couple of years after that, and then we had collapsing interest rates. So in actual fact, Australia really sailed through the GFC, and this time around it won't be the case, given the huge swathes of unemployment and businesses that are being shut this time around. Really encouragingly, you know, this is another one of those times where I think, you know, we've got to pinch ourselves at how lucky we are we live in this country. And, you know, again, by virtue of you know, the sea coastline, you know, low population density, we don't live on top of one another like they do in many other parts of the world, means that our curve will be flatter sooner than other countries, which is, you know, hugely important. The end of it all is, you know, we've had a really big pullback. We want to start adding risk to portfolios, but at this point in time, we think it would be imprudent doing so, because we think there's still too much uncertainty in the United States, particularly, but also around the rest of the world, in terms of, you know, just how likely and how soon we will be in stopping the virus spread. And I'll jump through a few things in this. In the last week, there has been a degree of reality finally being spoken by the president, but I still think they're a long way off really recognising this. This is a chart which just shows confirmed coronavirus cases by country. Hopefully you can see the countries there. What I've done is I've taken China as the base. And as you probably read, if you've been following the papers, there's a huge amount else to do. So you're probably all familiar that everybody starts with a country as at when they get to 100 cases, and then measures just how exponential the virus spread goes after reaching 100 cases. And so you can see there in the green, Italy reached 100 cases 35 days after China, and so on and so on. And so the red dashed line there is China. And they got a good sort of control on it by locking down Wuhan on the 23rd of January. But you can see, concerningly, the green line, which is Italy, and we've all seen the headlines there. And again, more concerningly, given the steepness of the curve, is the orange line, which is Spain, who are going through their horrible moment at the moment. And the blue line is really what's to come in the United States. And you can see there that the number of cases confirmed is significantly higher than each of Spain, Italy, and China at this point in the virus spread. And so that's the real concern there, that they have left things late. You know, 1 day of deferral, you know, is worth 8 or 10 days potentially. And so the concern obviously is that we're going to see quite a spike in the numbers across the next fortnight. New York have got a horrible couple of weeks to come, and again, the scenes there we've all seen, but unfortunately probably still another 10 days before that peaks. But the spread now, because of the inconsistent quarantining, is starting to emerge in other major cities around the United States, such as Chicago, Atlanta, New Orleans is a big problem. New Jersey, unsurprisingly, given its proximity to New York. And so I find it very difficult to believe that there will be a very short and easy to exit quarantine period in the United States, or for that matter, anywhere in the world, but certainly in the United States. And so I just want to make this point, because I think, again, we've all got a lot of time to think about these things. You know, in the last couple of days, things have firmed up, but I do think it's important to post this because, you know, markets are driven by humans and human emotion, and there's a lot of it going on at the moment. And I think, you know, it's a really great phrase that you've probably all heard, and my old bosses used to say to me, you know, with losing positions, hope is not a strategy, and it's true. You know, as I say, prior to the last couple of days, the view of the White House was that this was nothing more than the flu and that we would get over. And I think that was really hope and perhaps denial of what he was being told from the scientific front. His comparison in Brazil, Bolsonaro is taking a very similar view in that country as well. And I think, again, even though he's passed on the idea that he wants the United States opened up by Easter, I mean, that was a view he held only a week ago. They're now pushing for this idea of pushing or getting past the virus within 30 days. again, I can't see the science or the justification for it other than it's a great snap line. But, you know, when you consider, which I'll show you in a couple of the pages' time, the extent of the quarantines in other parts of the world, and when you consider the chart that I just showed you before in the context of the US infection rate, it's very hard to assume that the US are going to do such a great job that they'll be coming out of quarantine on the 30th of April, or that they'll be able to ease the social distancing measures that they put in place until that date. The other thing, this is a really concerning thing, I think, is that the population in the United States don't seem to take this particularly seriously either, or certainly not concerned about it in the way that others in the rest of the world are. And so the red line you've got there is weekly consumer confidence here in Australia. And you can see that that has plummeted, you know, in an unprecedented way as we've all gone into lockdown here the last couple of weeks. The white line, on the other hand, is US consumer confidence, which was released at 12:45 a.m. last night. So this is updated for that. It's barely come off the highs. And if I was to go back to, you know, 1980 or thereabouts, the current consumer confidence numbers in the United States aren't far off a 20, 30, 40-year high. So what that tells me, despite the enormous numbers of people signing on for jobless benefits the last couple of weeks, is that they really do believe the president that this is going to be over in a short period of time. And I think that that's really concerning. And I think that this is a problem with the way the virus has been portrayed in the United States, which is leading to, again, a false hope or a false expectation. And I think it's quite likely that there's going to be, if you go back to that cycle of acceptance I had 2 charts back, you know, you need to get to the point where reality bites, and you you know, you're pretty depressed by the situation before you can come out the other side. And I really don't think that the US are remotely in that position as yet. This is a really incredible chart. It's almost irrelevant, the chart, because the white line on the right is just so big. But this is jobless claims in the United States, the white line there. 6.5 or over 6.5 million people signed on for welfare benefits last week. It doesn't actually show the significance of the previous week before, because all you can see in that chart there that goes back 4 years is the jump to 6.5 million. Last week, it was a jump to 3.3 million. So we've lost 10 million jobs in the last 2 weeks in the United States, have gone, and people have gone to sign on for the first time for unemployment benefits. The US workforce is 160 million people. So we've had 6.5% of the workforce in the last 2 weeks sign on for benefits. The previous biggest jump in new jobless claim numbers came in 2008 and also back in the early 1980s. You can't even see that in the chart there. About 750, 800,000 new claims benefits came on in the GFC and in the early 1980s recession as well. So in the last 2 weeks alone, we've done 10 times that number. The red line is the unemployment rate in the United States, which you can see is at 50-year lows, effectively at 3.5%. Lord knows where it'll go to over the next few weeks, particularly if the quarantine is forced to be extended. But clearly, some economists are well within their reasoning to suggest that we get up to 20% unemployment in the United States, 20-25% fall in economic activity in the second quarter. So it's really significant. So I won't go through all of this because I think, again, everybody's read about these things in the paper. And to be really honest, it's the usual thing when you get numbers that are so big. They almost become slightly, not irrelevant, but hard to appreciate. I would say that all of these measures are not stimulus, they are bridges to you know, fingers in the dike, so to speak. Very significant fingers in the dike, don't get me wrong. I think, you know, if countries around the world had been slow to react to the medical crisis a month ago, they certainly couldn't be accused of that on the fiscal support side. Australia's had multiple packages, as indeed most countries have. The wage guarantees, I think, are good. The small business payments and the guaranteed loans are all terrific. But like anything in practice, it's the implementation. You know, when does the cash actually hit people's back pockets? And we've got still another week or so, I think, before that's the case here in Australia. In the United States, they don't even know, such as the way their public administration works. It could be as late as May, but they're really hopeful it'll come in the next week or two. And this is the real world sort of stuff that we're dealing with here. But there has been unprecedented stimulus, and I think that's been one factor that it has stemmed the bleeding in financial markets, in particular in credit markets, over the last couple of weeks. So that's undoubtedly a good thing. That's just an extension there, guys, of the household support that many countries around the world have implemented. The other thing too, again, clearly, 70 and 80% wage guarantees are fantastic, but it still implies that you were earning the median wage and you're now getting 20% less than that. There's a whole heap of people that clearly were making a lot more than the 50,000 a year or what have you, a median wage, and have seen a very, very significant hit to their household cash flows. Okay, so this is the quarantine timescales, and they're constantly being updated, but I think they're really significant because if you go back to my initial sort of thoughts and thesis that on markets not being able to rally until the US get ahead of the curve, you can see the extent of the quarantines going on in other parts of the world where I think they have been quite proactive, and it just again makes the US plans look, I think, really just quite hopeful at best. So you've got shelter in place in several large cities, but it's not been policed perhaps in the manner that we've seen it policed here in Australia, and certainly in parts of Europe in the last couple of weeks. Only 2 days ago did Florida actually go announce sheltering in place as a regulation. We've seen the huge number of spring breakers that have been in Florida and the South and headed back home, and now they're starting to see pockets of virus infections turn up. But the UK, France, Germany, they're all going deep into this month. I fully expect that we're going to see, we're already at the 3rd of April now, fully expect that we're going to see extensions to quarantines in Europe beyond the mid part of the month. British households were surveyed as to their expectations of quarantine, and all seem pretty resolved that they'll be extended another couple of weeks from the 6th of April. So the concept of the US being able to ease social distancing rules from the end of the month, I think is highly unlikely. At the bottom there, you can see, Wuhan was in absolute shutdown from the 23rd of January, and it's only opening up pretty much this time next week. And the Chinese have got some extremely strict measures to monitor people planned and still currently underway in other parts of China to ensure that pockets of virus outbreak can be squashed really quickly. There's a really good 2 or 3 minute news piece that one of the British journalists did about trying to get back into China before they actually put in place the ban on foreigners re-entering China. That's another factor. And just the significance of the testing that they are running, constantly taking temperatures, ensuring that people are apart, a huge amount of social tracking that's gone on in Korea and in Singapore, which has really had success. Again, in Western countries, we just haven't been able or willing to do that. And again, it just feels like the likelihood, anyway, on the quarantine period is that it will be here with us for a little longer. The frustrating thing with all of that is that that's desperately uncertain. But in the market at the moment, we're probably now getting to the point where there's a bit of value around. And we've sort of sat with a very patient view for the better part of 18 months and been underweight risk assets. And there were periods of time during the run-up in markets last year where it was really quite concerning and frustrating that perhaps we we weren't getting the best bang for our buck. But now, for the first time in a few years, that there is actually some reward for risk. We have seen some capitulation in markets. This chart just shows you the breadth of the market in New York, and what it just shows you, the 6.9 in the bottom right hand corner, everyone, is 6.9% of shares on the NYSE that are trading above their moving average. It reflects how many companies are trading well relative to how they've traded over the last year. And what you want to see in a market capitulation is that number as low as possible, because it means that people are selling everything they've got. They're not holding on to their winners and saying, oh, they'll be fine. They're basically saying, get me to cash. And so we have seen that. You can see that it was a very aggressive sell-off back in early March, and really isn't comparable to any other period other than 2008, 2009. I would, however, suggest and show you that if the quarantine period lasts a little longer, as we expect perhaps it does, that 2008, 2009 saw a 4, 5, 6 month bottoming out period at these sorts of levels before indeed the market started to rebound. So that there is that as a sort of slight concern, and perhaps a part of our central view at the moment that is holding us off from putting money to work just yet. But again, you can see we're getting rewarded now if we were to want to take risk. And so this is just the spread of high yield bonds, which currently are yielding a bit over 10% in the United States, and cash. But for the last 3 or 4 years, that spread had been somewhere in the order of 2 or 3%, which doesn't sound like a lot for investing in riskier company debt, and it wasn't. And so we'd avoided that, and now we've had the blow off, but encouragingly, as I say, and particularly too with the fiscal support from governments and central banks, I would say that we're now starting to get into an area where there's a bit of value around in some of these riskier assets. This is just, again, the price index for high yield bonds. So it's come off about 15%, which is pretty significant. In Australia, you've probably seen from the weeklies and some of the other presentations I've done in the last month or two, equities have underperformed bonds very significantly. It's been about 35%. Obviously, we've had a little bit of a bounce back in the last week or two off the lows, but that's a really significant move from an asset class standpoint. You can see from that chart there that equities had been really a strong performer from 2016 through to the end of last year, and then we've just taken a dive in the early part of 2020. But a really significant de-rating. As a result, you can see that the share market's now trading at levels that are becoming increasingly interesting. Clearly, we're going to get earnings downgrades, and that's to be expected. The debate then is just how quickly we see earnings recover in either the back end of 2020 or into 2021 and 2022. But this chart, I think, is really quite pertinent, because what it measures is the valuation of the ASX 200 against its long run earnings. So this is called a Schiller PE, which some of you might have heard of. And what it does is it just tries to smooth out the spikes in economic activity that you get. In bull market years, corporate earnings are really strong, and so they probably make the market look cheaper than it really is. And in bear markets, when economies are in recession, markets probably look more expensive than they really are. So this is a good one to take for long-term smoothed earnings, and you can see we're just under 14 times after the bounce back, and that's against long-run earnings. And it really hasn't been an overly strong period of corporate earnings in Australia this last decade. And back in 2008-9, we got down to about 11.5 times. So, having been at 20-year valuation highs at the start of the year, which were up around 20 times earnings, we have had a pretty significant pullback. We're now about to get the earnings downgrades, but we are now reflecting better value than we've done at any point. Certainly, I would say in the last 3 or 4 years, at least, maybe longer. The one thing that does again lead me to have a bit of caution again on going out and taking on some risk for that improving reward is that in times of financial stress, recessions and the like, understandably, households get very conservative. And we didn't really see a major uptick in the savings rate post the GFC in Australia. It did climb, but not in the way that it did in Europe and the United States. But because this is a proper recession this time around, with many people under pressure with their household cash flows, I do think that we're going to see an uptick in the savings rate. And I think for that reason, it's questionable to have too optimistic a view of what the recovery in the economy will be in the very near term as we come out the other side of this. You know, even though the government is offering a huge stopgap to businesses and households that have been affected by the situation, the reality is that we're all leading into savings to some extent. Businesses are running down cash flow, et cetera, et cetera. You know, that cash has got to come from somewhere. And more importantly, probably even more so this time around, because it's a virus and it's desperately uncertain and we don't have a vaccine at this point in time, households won't want to get caught short again, should this occur in 6 months' time as the Northern Hemisphere goes back into winter. And indeed, you know, here in Australia this time next year. So I do think savings ratios are going to climb, and that just means that we're not going to get the full bang for our buck of economic rebound on the other side of quarantine. So there I've touched on a few of those points already. Lower economic growth, you know, in really simple terms, guys, the way I would sort of describe it is that, you know, of the 10 jobs that have been put on hold or lost, invariably in times like this, only 9 come back. Just, you know, giving a rough example, you know, the huge amount of fiscal stimulus that governments are providing around the world needs to come from somewhere. And so that's the issuance of debt, which will be monetized by central banks, etc. But, you know, bond investors will be demanding higher prices. And as a result, higher real interest rates are likely to be a feature. And higher real interest rates just means that the valuation of everything needs to come down accordingly. You know, I think that Trump is under a lot of pressure at the moment in his presidency. And, you know, the potential is obviously he could be proved to be a one-term president, which would be negative for markets as well, given his free marketeering over the last 4 years. You've got this ongoing interplay between China and the United States at the moment. That, I guess, was the original deglobalization, and we've had it writ large in the last month or so with the virus. But the reality is we're going to see a separation in supply chains. The Chinese, post the trade war discussions last week, have made it very clear that they want to insource as much of their supply chain as they can and not be reliant on the United States where possible, which again has the potential for a depletion of Western world demand, if you will, as Chinese seek alternative sources. Again, consumer recession is quite likely here, given the size of household debt that we hold, and the fact too that I think, you know, a lot of our asset coverage is going to suffer because I think house prices are, having seen a massive rebound back in the last 12, 18 months, are set to fall again. But I actually think, and it started to happen the last week or two, that we're in the process of the Australian market and Australian assets, so particularly the currency, outperforming. And a lot of that's to do with our good fortune as a country from being separate from the rest of the world, our pretty sound fiscal balance sheet that allows the government to spend in the manner that they are, and again, our really blessed natural resources, and China's you know, effectively on the way back as we speak, and likely to continue with their infrastructure spend. So you know, we're going to have a tough time of it, but relative to the rest of the world, I think we're coming out sooner and we'll do better than many other countries around the world. So when the things come that we want to start buying, when the time does inevitably arise, which I personally think will be in the next month, we really want to be, if you will, high grading portfolios and really rushing into quality, you know, companies with liquidity. It goes without saying, but those companies that have growth that is not dependent on the economic cycle. So, you know, companies that have genuine growth stories from technology or brand or what have you. And so our hope is, while we might add to a few of the companies that we've got in the Aussie equity portfolio, we might add to a couple of the fixed income investments we've got on the defensive side, that there will be the opportunity to add some new high quality companies on the Aussie equity side, and certainly in the bond portfolio, to find some really highly defensible income that in a world of zero interest rates, I think will be really very valuable. That's it from me. I'll hand over to you, Liv, now.
Thank you.
And let's
Yep,
see.
awesome. So you can leave that slide on, that's fine. I'm just going to give you a quick superannuation update. Obviously, most people are aware by now of the government's temporary early access to super. So if you've been affected by COVID-19, individuals are that meet the criteria are eligible to access up to $10,000 of their super prior to 1 July this year. And they're also then able to access further $10,000 from their super after the 1st of July. So to find out more about that, just speak to one of your advisors if that impacts on you. Another relief that we were really pleased to see was that pension minimums have been halved, and that will extend not just for the 19-20 financial year, but the 2021. So if you have already drawn down in excess of the minimum and you're eligible to contribute to your super, you can consider recontributing part of that money back in. But again, seek advice in relation to that. We're really delighted to see that the ATO is providing or allowing for rent relief for related party transactions. So where clients own business real property and they lease the property from an SMSF, the government is going to allow them to give the tenant a temporary reduction during the 19-20 and the 2021 financial year. Other action items for trustees during these times are perhaps consider or get advice on a pension stop and restart. Obviously, many pensions would have started at a balance that are a lot higher than there would be if they were to commence and restart as at today's date. But there are consequences of commuting in pensions, so again, seek advice. And we recommend to make sure that your estate planning is up to date. I mean, most people don't have wills. It's prudent to have one. If you have an SMSF, you should consider having an enduring power of attorney in place. And finally, just a reminder that death benefit nominations aren't automatically dealt with as part of your will. So if you've got a death benefit nomination for your superannuation, make sure it's up to date as per your wishes and it's valid. So that's it for SMSF. We'll move on to questions and answers. So we'll get Mark back on the line. And we'll kick off. First question for Mark is, do you think that banks are a good buy at present?
Yeah, banks it's an interesting one. The share prices are off something like 30 to 40%, depending on which bank we're talking about. And there's been a lot of talk in recent times how they're in a much stronger financial situation than they were going into the GFC. The capital ratios are much higher. They've got more cash on their balance sheet. So they're certainly in a strong position, but they are, financing the economy, and the economy is taking a hit. You would expect to see that unemployment is going to increase and increase pretty dramatically. I mean, Jono sort of gave us a bit of an insight to what's happening in the US with jobless claims rates. I think a lot of industry in Australia under pressure, particularly the hospitality and tourism areas. We're going to see an increase in unemployment, so people servicing their loans. There is a period of where the interest rates will be frozen, but that's going to have an impact. And clearly with some businesses that have got debt and whether they're still able to survive is also going to have an impact. So the banks will see an increase in bad debts. Banks are reporting in 4 or 5 weeks. I think the one thing we will see is certainly going to see increased provisioning for bad debts. And then as those numbers come througll have an impact. I guess the other thing for a lot of our clients, a lot of investors who have a self-managed super fund, banks have been a core part of the portfolio because they've had such good dividend yields. And those dividend yields are going to come under pressure. And our view, they're going to come down. To what extent remains to be seen. But we've certainly seen in the UK and in New Zealand where central banking authorities have basically given instructions not to pay out incentives or bonuses to senior management, and in fact to restrict the payment of dividends in those places. So globally, it's a suggestion that they're going to be under pressure. APRA at the moment have come out and said, well, we're going to leave that to the boards of the banks to decide on how to manage their finances. But at the end of the day, given the recession that we're going to have, and whether we have 2 or 3 or more, we don't know, quarters of negative growth, you know, that'll have an impact. So, you know, banks are off 30-40%. They are the mainstay of the economy, and ultimately we think they're going to be, they will be a good investment. But it depends on your reason for investing, and if you're investing for a dividend, you know, it's quite likely you're going to be have some pressure on those dividends being paid. Longer term, banks off at this rate, you know, they're back to PEs of 8 or 9 times versus where they were not so long ago when, you know, 14, 15 times for banks. So there's value there, and certainly long term we like the banks, but short term they're going to suffer some pain with the economy. Okay,
thanks. Jono, somebody has asked if the rate of infection graph is up to date.
Yeah, and that's how efficient I am, Liv. I answered that one. It is. I did it on the email. It is. That's up to date as of last night, this morning. But understandably, it's it falls out of date very quickly, unfortunately, at the moment, given the rate of infection.
Okay, so Mark, if many Australians do take advantage and take the 10 to 20K out of their super funds, will that affect the overall returns that super funds can yield?
It has to, because at the end of the day, if you, and this is, you know, we talk about this in personal portfolios, if we've got sufficient cash in the portfolio that you don't need to be selling assets at a time when prices are depressed, you have the ability to ride it through. But selling assets out of super when you've got a 30-40% drop has to have an impact, because you're not going to be able to recoup those values. So ultimately, you know, advice to clients is if we can ride through this period, because we will come out the other side. It is, in the context of things, it'll be a relatively short-term issue, we hope. So yeah, it will have an impact, and you know, if it's can be avoided, we prefer not to be selling down assets at this point.
Okay, so Jono, do you expect domestic fixed interest investments to deteriorate during the year? If so, where would you recommend this be invested in?
Yeah, I saw that, and no, not necessarily at all. Listen, when economies struggle, obviously some businesses go bust and some personal loans don't get paid. I don't foresee a huge concern in any of the fixed income investments we have recommended in the last 2 or 3 or 4 years at all, where on a mark-to-market basis, some of the listed investment trusts that we've been big supporters of, such as the Metrics Master Income Trust, MXT, Metrics Opportunities Trust, MOT, and the Qualitas Real Income Fund, QRI, they are trading below NAV, but the income and quality of the assets underlying those, I think, are still very sound. And maybe, Liv, if I've got the time, can I just give a 60-second summary on that? Because I know it's been a topic for a lot of people, and it is in a lot of portfolios. We took a view over the last couple of years that we didn't really want to be in government bonds, and it was actually probably too soon a call that we made it. But in the last 3 or 4 months, again, it's actually proven to be right. Getting paid 1.5% for a government bond just didn't cut the mustard for us, particularly when if you see a sell-off in the bond market, you can lose many multiples of that yield. And that's happened on occasion in the last couple of months with the volatility. And again, with governments issuing huge amounts of debt, it has even less attraction to us. But in the case of the fixed income that we've chosen to invest in, we think that the income is really, really sound. We've been really exposed to property debt in this country, which I think is still a really good way to be exposed. So Latrobe is still a very large holding for us. We've trimmed it a little bit just because of the fact that you can't get your money out any quicker than a month, and I just think investors want a bit of liquidity, so we've trimmed it down. But you know, a low 5% monthly income for investing in Australian mortgages is I think just tremendous risk reward. Artesian high, the Artesian investment grade bond book is down about 2% or so, just with the blowout in interest rate spreads. But that's one of the best performing fixed income funds. Most fixed income funds have lost money in the sell-off as well. So that's been really quite protective. And then in the case of the listed trusts, Metrics is about 2/3 in senior secured loans, of which half the book is investment grade. Investment grade bonds have probably only lost 2 or 3% thus far year to date, which isn't a huge amount. And then the remainder of Metrics's business is private equity debt and secure debt over property, so construction loans, mortgages, first mortgages and the like. I'd be lying if I said that I didn't think that there would be some of the borrowers, but again, remember Metrics got 150 different borrowers. Some of the borrowers, I think, asking for a delay on principal repayments, or maybe moving interest from monthly to capitalised. But it's going to be a very small fraction, I think, of the overall portfolio. And again, I keep coming back to this fact when I talk to people, this is debt, not equity. So there's someone that's going to take the hit well before these guys do. So in truth, whether it be Qualitas or the Metrics portfolios, I really don't feel particularly concerned about the income that's going to come off it. It's frustrating to see them trade at a discount to NAV, but everything's trading at a discount to where it traded at before, because we're all chasing cash and liquidity, so everything's being sold. And it probably will take 6 months or so for both of these trusts to push back up towards their NAV. But their NAV, I think, is really quite sound. And if we were to get a pullback to the levels we got 10 days or so ago, and again, I was a little bit slow with this in truth, but markets move fast. We probably had been at the point, Mark, on the investment committee where we would have bought more of these things, because, Metrics, at 120 or 130 was probably yielding 9%. Qualitas at $1 was probably yielding 10%, but still had 20% of its business in cash. So I'm not overly concerned. I think that these are good, solid incomes, and arguably they're better income than they were before, because interest rates are now virtually at zero.
Okay.
And then on international equities, which I can see there as a second part of that question, we have the same view that we've had before. I mean, Australia's 2.5% of the global economy. Banks are 20% of the market. Telstra and CSL and Transurban, and the miners are a large part of the rest. That they aren't. It's not a strong secular growth sort of thematic that you get off the major companies in this country. So we think that there are better opportunities to make longer term returns in international equities. What we would say now, though, is that a huge proportion of returns that people have made on international equities in the last 5 or 6 years, almost 40% of all the returns, like 11, I'm not going to be exact on the numbers, but it's not far off, 11% type returns the last 5 or 6 years on international equities in Australia, relative to, a standard 7% return if you were in US dollars. That's a huge gap, has come from the currency weakness. So if I was investing, and we are slowly doing it in our recommended accounts, if I was buying equities now straight away internationally, I'd be buying the hedged version of the funds. In no small part, I think that the currency at 60 cents is probably finding a low.
Yeah. So Graham's asked a great question here. He said CSL and COH have weathered the storm reasonably well. At what price would you buy?
I wouldn't touch either of them for at least 20%, at least, probably more, Graham. I mean, in large part because people are hiding in them, for one. The currency comment I just left before will be, if I'm right on the currency, will be a drag where it's been a huge support. And as people get confidence in other companies that have been impacted by the coronavirus come back, then they will naturally reduce their holdings in these companies that they have hidden in. The valuation on CSL is extraordinary. Cochlear, in the same vein, raised $800 million in a surprise raising a week or 10 days ago, and has recouped 2/3 of what it's lost, despite the fact that cochlear implants are down 50% and probably unlikely to rebound back anytime soon. This is, these companies are really good quality companies, don't get me wrong, but this is the classic herd behavior that is going on at the moment, that as confidence in the market comes back, it will unwind.
Okay. Now, Steve asks, what may be the long-term effect of the payback of the $180 billion bailout? Do you think it will be evenly spread? And will the Treasurer stop talking about Labor's debt?
Lifetimes, Steve. I mean, once you start going down a path of this size, I mean, we're crossing the Rubicon here. There's an argument, which I won't bore on, about modern monetary theory, that it doesn't matter how much debt you issue, that's for another time to discuss. But certainly governments around the world are in no rush to repay that debt, in large part because their respective central banks are monetizing it. So they don't necessarily have to. We're just seeing the money supply expand. We might have an issue on the credit rating of the country, which will have a knock-on effect to the cost of debt for banks and what have you. But again, we're talking about 10 and 20 basis points here. It might mean that the tax cuts that were slated to come in 2022 and 2024 might get deferred or ignored, which is probably a bit frustrating for a lot of people because they were really very significant. But we're decades away from paying back that debt. But I would also say too, and this is the ridiculousness of investment markets, everything's relative. And so we obviously were in net surplus when Costello was Treasurer, which a long time ago now. But we were probably 20-25% net debt to GDP last year. With these promised spendings, and again, we don't even know how much of the plan will be spent ultimately too, Steve. We'll go to 80% of debt to GDP, which is about, again, all these numbers have changed because everyone else has got major programs, but it's about where, the likes of Germany or Britain were 65%. It's probably where they were, and where the US was a couple of years ago, although the US is exploding through 100% of debt to GDP. Japan's at 230. No, maybe Japan's actually in the 300s even. So we're relative to everyone else, we're still not as troubled. And so if the rest of the world are going to continue to do it, then I don't see it as being a problem. This is going to be the classic can kick down the road, generations.
Yeah. Okay, and probably the last question for the morning then is from Rhonda, who quite rightly points out that we will have to pay back the government support at some point in time. Is there any intel about likely changes to taxes or new taxes, death duties, gift duties, or the taxation to franking credits and super?
Well, on the tax duties and the super stuff, I'll leave that to Mark. I would say though, Rhonda, I mean, we don't really have to. I mean, a lot of these things are going to be payouts. I mean, we might pay it back, to Steve's question, at some point through higher taxes for paying the debt off, but that's many, many years to come. And yes, the interest deferrals will have to get paid back. There's no doubt about that too. But a lot of these payouts are going to be cash handouts.
Mark, did you have anything to add to that?
Look, the prospect of, I guess the focus of authorities and governments at the moment is really to have the economy in hibernation, the holding pattern, so we can come out the other side. I think they're all very sensible things that we're doing to keep the economy going. Some of that debt will be have to be repaid at some future point. So we would think that maybe some of the tax cuts that come through maybe get pushed back, or maybe there is, the GST is affected. They're all things that I'm sure Treasury are considering, but I think at the moment it's not their immediate focus. And I think getting through this crisis is where people's putting their attention, and to some extent we'll have to deal with that a little bit down the track. Yeah.
So as we finish up today, I'd just like to thank you both for your time, and also just let you all know out there that our thoughts are with you all during this very difficult time. So stay safe, and a copy of this presentation will automatically be emailed to you. So give us a couple of days for the team to put it together, and a copy will be emailed out. Thank you very much, and have a good day.